All right, so now we're kind of jumping into the second part of our discussion on the income statement. We're going to be talking about earnings quality, and so we're going to kind of jump right into it. So, what's the most basic definition of earnings quality? And it's really about the ability of reported earnings or income to predict a company's future earnings. If you remember, we talked about within the conceptual framework that the way we define useful in accounting is that it's predictive, or we can estimate the amount, timing, and uncertainty of future cash flows. And so when we think about more useful or higher quality earnings, it's going to be more able to provide that predictiveness. And so that is how we think about earnings quality. Higher quality earnings are more predictive than lower quality earnings. And so a key feature, kind of as a launching point when you're thinking about earnings quality, is distinguishing between, temporary earnings, those items that kind of just are momentary, non-recurring, aren't likely to persist, and then permanent earnings. And permanent earnings are those that are likely to persist. And so you think about, sales revenue. That's an item that, the company kind of by definition is going to continue to do. That's a very permanent component of earnings. Whereas something like a gain on sale from equipment, odds are you're not doing that quite as often. And so that's more of a temporary kind of earnings. And both of those are revenue items, of course. And you could similarly have ideas on the expense side. And so, again, the whole idea here is make that distinction first. Is this more of a permanent item, or is this more of a temporary item? And so a very broad and easy distinction between temporary versus permanent earnings really is continuing versus discontinued operations, because of course, by definition, discontinued operations are not going to persist, and so they are temporary. Whereas continuing operations, at least in part, have a permanent component. But you should be aware that even within continuing operations, there are certain items that are less persistent, so they are more temporary than others. And so it takes a lot of experience, takes a lot of exposure and just judgment to kind of understand, when I see an income statement, what are those items that are more likely to be permanent compared to the temporary items. And this is something that financial analysts do a lot whenever they're trying to predict earnings, is they're trying to understand, what are those components that are going to be repetitive and recurring, and which ones are not. And so, that's just a challenge. If you're going to try to do, sort of, I would call it financial statement analysis or anything like that, is making that distinction. But even with that judgment and that experience, ultimately it is an estimate, and it's subjective, and that two professional, well-trained analysts could look at the very same company and have different perceptions of earnings quality for that company, or especially the permanent recurring portions of earnings. And so just be aware that, this isn't mechanical. There's a lot of, I would say, objective steps, but ultimately it is a subjective process. All right, let's kind of talk about two factors that I think can complicate understanding earnings quality, and that's income smoothing and classification shifting. And so when we talk about income smoothing, another term you may have heard is called earnings management. And basically what we do in accounting is you probably already started to figure out, there's a lot of estimates and judgment that we use in the accounting process. And so, while that judgment is supposed to be unbiased according to the conceptual framework, the reality is these judgments are not made in a bubble. And so managers and accountants are aware of the overall financial health of the company. They're aware of shareholders. They're aware of what was reported last year. They're aware of what they think is going to happen next year. And so sometimes managers will use that judgment, I would say selectively, in order to shift income on the margin to make earnings look smooth. And I'm not talking about fraud. I'm not talking about violating the rules. What I'm saying is there's flexibility within the rules. And sometimes managers will use that flexibility to communicate a smooth picture of earnings. And it kind of makes things look more predictive. I mean, if you think about a company, let's think about, the 8 quarters ago, they reported 25 cents a share, and then it went 25, 26, 27, 28, 29, 30, 31. If you were to have asked, what do I predict is going to be next? I predict 32, right? Because it's this path that you can see, a very smooth path. But understand the real income may have been, 24, 26, 25, 28, 27, so it could have been bouncing. This upward trend probably was there, but it may not have been as smooth as it looked, because you can take a small portion of the earnings and kind of shift it a little bit to get a much smoother path. And so just understand that there is that flexibility within financial reporting, and that some managers will use that more than others. The other thing is called classification shifting. And the biggest one of these, in my opinion, is distinguishing between cost of goods sold and operating expenses. And even maybe more so in other operating items. You can kind of see a shift maybe between those things. When we talk about income or classification shifting, what makes something a non-operating item versus an operating expense? Well, again, non-operating would be those things that you've deemed not revenue related. And so maybe there are certain expenses that, you're kind of like, well, it maybe falls in this gray category where it could be operating, or maybe we're going to call it non-operating. I do think it gets a pretty squishy when it comes to shifting between those two. I do think there's a lot more shifting in between cost of goods sold and operating expenses, because whether it's depreciation or certain labor or certain materials, there's a lot of judgment on what is a cost of goods sold and what is an operating expense. But either way, the further you push an expense down, there tends to be a perception that that expense is less material, or even, I'd say not even just less material, but less persistent. And so if you can shift an expense to a lower classification, then markets sometimes will perceive that as being less persistent. And then obviously their ideas on your income, they're going to have higher expectations going forward. And so again, it's not to say that you're not talking about breaking the law or committing fraud. What we're talking about is using judgment within the rules, and some folks will use that judgment more liberally than others. And so kind of two main points from all these issues. Number one is income smoothing can produce a picture of predictable performance, but things are kind of hidden because there's this active management. And then classification system, we're not talking about breaking rules. We're talking about shifting things up or down. And so your net income ultimately is the same, but your measure of gross profit or income from operations might look a little different depending on where you shift those expenses to. All right, let's kind of jump a little more into operating income. So again, operating income are those expenses and revenues, sort of directly related to the core operations of the company. And again, operating income on average is considered, more permanent than other measures of income. But there are aspects of operating income that may not be. Those temporary items, whether it's a one-time charge or think about COVID, things like that, where you're classifying expenses that may have been to, change the workplace environment, were those listed as an operating expense? Were they a non-operating item? What did you do with those? But there could be, very temporary items that are included, and that can skew income up or down. Obviously, if there's sort of a one-time push to your revenue, that would increase your operating income. And if you had a one-time drop in your expenses, that would also increase income. Of course, then you could have the opposite effect. So, careful analysis, that is the answer. When you think about earnings quality and how vague and how maybe ill-defined on some level it can be, the reality is it takes a lot of judgment to assess quality of earnings and to think about what the financial statements are communicating, and especially what that might be saying about future performance. And so, you got to analyze those financial statements. You have to read the notes. You have to look at the industry. There's all kinds of things that go into really assessing earnings quality. And so that's why, finance and accounting people sometimes can get paid a lot of money to do what they do, because they can provide information that an investor or someone else might not be able to ascertain on their own. There are really two things in the textbook in addition to everything we've already talked about, that they kind of highlight as having unknown or maybe varying impacts on earnings quality. And one of those is a restructuring cost. And so restructuring costs are meant to be fairly limited in their scope, and that, it's a cost that's been incurred to reorganize or plans to materially change the scope of a company's operations. So these are not something that happens every year. This is a planned action that is a significant change to the company. And so the question is, what do you do with those restructuring costs? Because they can be quite substantial. But of course, they're not ongoing because it's a one-time shift. And so how do we handle those? And so, we do treat them as non-recurring. So they are temporary items, but they are accounted for over a period of time, usually through estimation and cost allocation. So a lot of times when you decide to restructure the company, you're estimating the costs, and then you're going to allocate that cost over a certain period of time, however long you think that restructuring process is going to take. And so understand that kind of has an interesting effect. First of all, you now have allocated a cost on a fairly consistent basis over a defined period of time. Well, there's really nothing more predictable than that. And so there's this mechanical predictiveness to restructuring costs in the way that they're reported, but the actual cash flows may be very different than the way you're allocating that cost. And so that smoothness could be very misleading if you didn't adjust and think through its effects. And so that's a really important aspect to restructuring costs. And then you do have these other unusual items or special items. And so these are atypical costs that are incurred during a period. And so there is judgment on what you deem as a special item or an unusual item. And so again, analysis and careful reading of that particular item needs to take place, because you as an investor or analyst may look at something that the firm has said is special or unusual, and you may actually kind of think, well, I'm not sure that it is so special. As an example, you could have something like a litigation cost where litigation is an ongoing part of a business operation, but yet they're saying that it's a special item. And arguably they're right in that, this one lawsuit is unique, it's unusual, but is ongoing litigation unusual? Probably not. And so for a lot of firms anyway, especially where there might be a lot of intellectual property and things like that. And so just be aware that just because a company calls it unusual doesn't mean that it necessarily is unusual. All right, so we're going to kind of keep down this path of looking at these unique items and how they impact what we report on the income statement. And so we're going to talk about non-operating and non-GAAP earnings. So first of all, of course, non-operating items are those things we've already kind of highlighted. So gains and losses that are non-recurring and typically very temporary. But there is this other term that I want us to start to understand, and that's what's called non-GAAP earnings. Now, I introduced this term when I talked about the manager discussion and analysis. And the reason why I talked about it there is because a non-GAAP earnings, it's a voluntary disclosure of earnings. And it's basically what management is saying, this is our permanent component of earnings. This is what we believe is going to be recurring and persistent going forward. But it is not defined by GAAP itself. So it's a very loose term that can vary greatly from company to company to company. For sure, it's going to exclude certain expenses, sometimes certain revenues, but there is, again, complete flexibility in the way that they define it. Now, I will say that Sarbanes-Oxley did address this issue of having wide variation in non-GAAP earnings. And they basically now require there has to be a disclosure that reconciles non-GAAP earnings and GAAP measures of earnings. So if a company chooses to report non-GAAP earnings, they have to reconcile it to GAAP earnings and kind of basically say, this is exactly how we got from point A to point B, which hopefully, again, provides better information to financial statement users. So we're going to kind of end this lecture here, and we're going to pick up with discontinued operations next time. So again, that puts us right about 15 minutes. I think it's a good place to stop.